Okay. Yeah, once again, good evening. Hope everyone's well. I feel like I was here mere hours ago. Oh, wait a minute, I was. And there are some who shall remain nameless who were also on the call this morning. So there must be something in this. But look, no, thanks for joining another Kepler webinar. This time we're going to focus around what's happening on the new refinery in Nigeria, the Dangote Refinery. Focus on its implications for crude oil markets. We've got our expert Victoria Grabenvoger sits in Vienna. She'll be starting with some crudes, what's implications for crude oil markets, balances. Then we're going to move on to the refined product side of the barrel with a good friend Sumit Batalia, who sits in India. And then we're going to see the implications for tanker markets, clean and dirty, and what's happening there, what's going to happen with flows. There will be time for Q&A. So just fire any questions. We've got some that weren't answered this morning that we imagine will carry on the same theme. But look, little old me, who am I? For those of you who don't know me, that's lucky you. My name is Matt Stanley. I sit in Dubai. I'm head of market engagement for Europe, Middle East, Africa, and Asia, which is quite a large region. And that's why I'm not eating my dinner at 7 o'clock. I'm talking about the Dangote Refinery, but enjoy it, I do. Look, we just want to move on to the first slide, and I'll let the guys start on what their expert fields are. Look, I've worked in your business 24 years now. I've spent a lot of time centered around West Africa or Africa in general. I have a podcast. I have my good friend Russ. We've spoken about the Dangote Refinery for the last nearly 2 years and its implications for markets in general. You know, if you're a Northwest Europe non-oxy gasoline trader, if you're a crude trader in the States, if you're selling barrels out of Jamnagar, it has an effect on everyone. This is two quick slides that we've got. One slide, sorry, two articles, two diagrams. Get my words out, 7 o'clock. The first one, you can see there, if you just zoom in on the left-hand side, you can see the exclamation mark. That's where the Dangote Refinery sits, in the Lekki Free Zone. Not just a big deal for the local community within Lekki, not just for Nigeria, West Africa, but the Africa continent as a whole. $12 billion of foreign direct investment, 70,000 jobs over the course of the last 11, 12 years. You know, the construction and services and local amenities, and 2,500 permanent jobs that we picked up on the back of it, and a major change in trade flows and patterns. The diagram on the right-hand side is actually from the Dangote Refinery. So don't tell us we don't, put some thought into this. But look, I'm going to hand over to Victoria. She knows a lot more about this crude, this stuff than I do, to start on the crude side. So I'll catch up with you when we're going to move on to products. Right, thanks. And thanks again for joining.
Hello, everyone, and thank you, Matt, for the introduction. My name is Victoria Grabenvoger, and I'm a crude oil analyst at Kepler with a regional focus on Africa. So one of my frequent tasks, for example, is modeling OPEC Africa supply levels, looking at other upstream expansions in the continent. I also recently wrote the Dangote white paper that some of you might have received in your email inbox. And today I'm going to talk about Dangote's impacts on crude oil markets. Yes, so next slide, please. So let's first start with looking at what has discharged at the refinery so far. We first should remember that there are no crude pipelines going to the Dangote Refinery, which means that oil can only arrive via sea. And so looking at the crude import so far is a good indication if we want to estimate at which levels the refinery is running. Since December, there have been 43 crude vessels arrived at Dangote, and 1/4 of the shipped volumes has been WTI Midland, which is the red color here that you can see on the charts. And 3/4 of the shipped volumes have been Nigerian barrels. Of the domestic grades, the top 3 imported have been Amenam, Bonny Light, and Forcados. And all of the barrels that discharged so far at the refinery have been light sweet grades in the 31 to 50 API range and below the 0.5 sulfur limit. And this crude feedstock, of course, makes sense given that the refinery is configured to run on light sweet grades, in particular for Forcados, Escravos, and Bonny Light. Still, it did come to somewhat of a surprise to the market that we have seen so much US crude being bought by Dangote. It is a very long voyage, as you can see on the chart on the right here. But we need to remember that actually it has simply made economic sense for the refinery to buy WTI recently, because despite this longer voyage time, the delivered price of WTI to West Africa has been below the price of some domestic crude, such as Forcados and Quaibo. In addition to this economic benefit, WTI has a big quality benefit because it has an API above 42, which means that it yields a lot of light and middle distillate cuts and less residue. And this is of particular advantage at the moment for Dangote, given that their secondary units, or most of them, are still not online. So yeah, when we look at the crude imports chart, we see that in May, we have seen around 230 KBD discharge at the refinery. And in June, this has jumped to an impressive number of 370, which is an indication that runs are constantly on the rise. One very important question that everyone is asking themselves is, which crudes are we going to see in the future being bought by Dangote? And we currently believe that the focus will continue to be on domestic grades, as well as light sweet US barrels. This is especially because Dangote has secured a 12-month offtake agreement recently to feed 2 million barrels of WTI into its refinery starting this month. Also, earlier this month, news emerged that the refinery issued a tender of seeking additional US crude for delivery in August and September, and this could result in an additional WTI-laden Suezmax or VLCC in these months. And even though WTI has been the only foreign crude that has been imported so far, other potential barrels could be imported from West Africa. So we believe that other light or medium sweet grades from countries such as Angola, Ghana, Ivory Coast, or Gabon could be bought by Dangote going forward. Next slide, please. Yes, so let's now turn to the question what our expectations of Dangote's crude intake is in the midterm future. So first, it should be noted that Dangote is a single train refinery, and in general, a single train refinery must run at a turn-down ratio of 40 to 60%. In the case of Dangote, it means that the plant must run around 300 KBD. If we look at the past few months and we see a lower monthly average than 300 KBD, this is because the plant has been switching between being online and being offline for fixing emerging issues. So being in this on and off mode of operations, which has taken intake to around 250 KBD in May and 270 KBD in June in our estimates. So looking to the rest of the year, we think that Dangote will manage to consistently run around 300 KBD, implying that it is running very close to half capacity for the rest of the year. Looking to 2025, we think that Dangote crude intake could move above 400 KBD, which is equivalent to 60% capacity. And in 2026, we think that the refinery could reach operational rates around 80 to 90%, which would be 550 KBD. Finally, it should be emphasized that we do not expect Dangote to run at 100%, simply because running a single-train refinery is very technically complex. And we think that around 5 to 10% would be consistently taken out because of maintenance requirement and unplanned operational issues. Next slide, please. So obviously, considering this outlook on increasing Nigerian refinery runs, A major implication is that more domestic barrels will be needed, and therefore fuel will be available for export. We have already seen a first indication of this. In 2023, Nigerian crude and condensate exports averaged around 1.5 MBD. And since December, we have seen a gradual decline of these numbers. So outflows actually dropped close to 1.1 MBD in April. And this development has been in line with test runs at Dangote starting at the turn of the year and constantly rising since. So when we think about the crude feedstock at Dangote, we are currently assuming a 70-30 split of domestic versus foreign grades. And this assumption makes sense if we look at what has been imported to Dangote so far, which, as I mentioned in the first slide, has been 75% domestic grades and 25% foreign grades. And if we go with this assumption, then this would mean that later this year, Nigerian crude and condensate exports would be pressured to around 1.2 MBD, which is 20% below year-ago levels. And looking to the end of next year, exports could be pressured as low as 1 million barrels a day, which would be 30% below 2023 levels. And this development will, of course, have an impact on prices. So the reduced availability of Nigerian oil will certainly push West African spot premiums higher, particularly towards the fourth quarter of this year. And this should also have a ripple effect on other Brent-pegged light grades. We think that there are several countries that might have to find substitutes for Nigerian barrels that are not anymore available on the market. First and foremost, this will affect countries for which Nigeria is the main crude supplier. So this is South Africa, Indonesia, and Ivory Coast, as you can see on the chart on the right. We think that these countries could potentially turn to Angola, the Americas, or the Middle East for additional supply. Also, when we consider that the largest share of Nigerian exports actually goes to Europe, there are also several refiners that will feel the squeeze. So the major buyers in Europe are Spain, the Netherlands, France, and Italy. And these buyers will potentially turn for additional light sweet crude supply to the US or the Mediterranean. Next slide, please. Yeah, so if we assume that 30% of Dangote's crude feedstock will be imported from other countries, this also means that Nigerian crude imports will constantly rise. And we think that this would result in an import requirement of around 100 KBD towards the end of this year and could move to 150 KBD in late 2025. When we think about the 12-month offtake agreement of WTI that I already mentioned, this would be equivalent to 60 to 70 KBD. So this could already cover a substantial amount of these import requirements. However, we also think that Dangote might start importing other foreign grades. And West African grades would make the most sense also because of their geographical proximity and the quality. So, for example, Angolan Nambar or Plutonio, Ivory Coast New Baleine grade, or Gabonese Rabi Light would be very suitable grades for Dangote to buy. Yeah, and if we assume a heavy buying of Dangote from the West African region going forward, then Asian buyers of these grades might also be affected. So when we think about the fact that China relies on West Africa for 30% of its light sweet imports, it might be that China will have to replace some of the Angolan barrels. And we believe that China could look to similar quality imports from countries like Malaysia, Indonesia, or Russia's Far East. If we imagine a scenario in which Dangote does decide to cover all of its import requirements with WTI, it might be that next year Dangote would consistently import around 150 KBD of WTI. And in theory, this could impact frequent WTI buyers in Asia and Europe. So in Asia, that would, for example, be Singapore, Taiwan, and South Korea. However, we also expect US shale supply to grow in both 2024 and 2025. And so we think that this supply growth would then also balance out the increased need for US barrels. Next slide, please. Finally, it's important to remember that the continued ramp-up of Dangote will depend on many factors, and unforeseen incidents, such as the recent fire that was reported at Dangote, could easily change the course of events. So in order to imagine different outcomes to our base case, which is the orange line that you see, we have also modeled a low runs scenario and a high runs scenario for crude intake at Dangote. The low runs scenario is the gray line that you see there, and it is a pessimistic outlook in which Dangote struggles to progress beyond the levels at which it is currently operating. So in this case, Dangote would simply run between 250 to 270 KBD for the rest of this year and next year. We would have no secondary units starting up in this case. And yeah, if this scenario materialized, then all of the projected impacts on crude markets I was just talking about would be reduced, or it would just not change very much from the status quo. So we'd see a continually high Nigerian crude exports. We would see Nigeria continue to buy high volumes of gasoline from Europe, a continuation of straight run products exported out of Nigeria due to the lack of secondary units, and also pressure on Nigerian crude prices as these grades remain plentiful available. In the high run scenario, which is an optimistic outlook, and it is the dark blue line on the chart, Dangote's ramp up is realized faster than we expect in our base case, because technical problems are overcome quickly and not that much maintenance is required. And so in this scenario, Dangote manages to operate above 70% already later this year, and manages to move to 80 to 90% of capacity in late 2025. And such a sharp ramp up in crude runs would likely disrupt crude markets for a while, as Nigerian crude availability would drop rather quickly. And we would also, for example, see pressure on motor fuel cracks in Northwest Europe and the Med, as European refiners would likely struggle to find homes for their product barrels, as Dangote would be able to produce its own gasoline. Yeah, thank you for your attention. I hope I could give you some insights with my part of the presentation.
Thanks, Victoria. That was brilliant. Look, I just want to let everyone know as well that we're available for calls afterwards. Reach out to Victoria, reach out to any of us once we're finished. But the slide deck and the recording will be made available to everyone. So have a look at that, digest it, and then let us know what more you want to see. I mean, the big takeaways: good news if you're a WTI trader, bad news if you're a Spanish crude buyer. But this is what we were saying to start with, wasn't it? Everyone is impacted. But no, look, thanks a lot, Victoria. Right, let's move on to the product side of the barrel, and I'll hand over to my good friend Sumit.
Thanks, Matt. Thanks, Victoria, for the insightful presentation. Hello all. Good morning, good afternoon, good evening. Where are you based off? I'm Sumit Retolia. I will be presenting impact of Dangote's refinery on the product market. So yeah. So before we dive into how product markets get impacted with respect to Dangote, let's have a look at how the refining capacity has been changing over the year. So COVID-19 may seem to be a thing of past, but the period along with the Russia-Ukraine conflict has been a watershed moment for the refining industry. After 2 consecutive years of decrease in capacity that we have seen in 2020 and 2021, refining capacity began to show net addition in 2022. And from 2023 to 2025, we assume around 2.5 million barrels per day of identified net addition after allowing for closures. Expansion in India, Balkipan, along with Dangote Refinery, China's Yulong, and Mexico's Olmeca will be added to it. So the key takeaway from this slide is that center of gravity of refining has shifted east in the last 2 to 3 years. As the West has been rationalizing, cutting capacity, we have been seeing a continued buildup in the east. So particularly this year is expected to see a large capacity buildup, courtesy to Nigeria's Dangote and China's Yulong. We all know that it is getting delayed, but Yulong startup expectation is later quarter of this year. Yeah, next slide, please. Yeah, this is an interesting slide. So before I get deep dive into it, so the main focus of this slide is, yeah, large scale refineries are delay prone, and usually they take years or even years to reach the full output. So I am comparing two refineries, two mega giants, like one is Reliance Jamnagar and one is Dangote's Nigeria. So if we see on the left hand side, for Jamnagar refinery, from initial conceptualization to construction to the final product output and handover of the refinery to the Reliance industry by the licensor took 10 years, 10 long years. And on the right hand side, we see that Dangote, it has been a long story. First of all, the construction got delayed due to various issues impacted with COVID, financing, and other stuff. And we have been seeing a slow and lengthy ramp up as of now. So we believe, as Victoria also mentioned, that we believe the ramp up will be slow because, yeah, the single train refinery of this size is expected to face various issues. And we have seen in what happened in June 26, though that has not affected any production, we believe, but full scale ramp up is expected only at the 13th year of its conceptualization, that is around H2 of 2026. If history is a gauge, like we can see from the recent startup of the various large-scale refinery like Jizan, also Rapid Refinery in Malaysia, they have been, the ramp up has been slow. And in fact, if I talk about Al-Zur, like 615 kbd of refinery, it has been running from last 2 years, but they have been running at a maximum of 75%. If we keep apart the process guarantee test run that they did in March and April. So still they have not been able to ramp up with 100% capacity. Same the story has been with Vietnam Nisong refinery. So if I can particularly say on that, for the Nisong refinery, from the first crude intake to the maximum product output, it took them long 33 months. That is nearly 3 years. So yeah, we are in for a long, slow, and delay ramp up of Dangote refineries. Yeah. Next slide, please. Yeah. So in the next two slides, we'll be sharing our view on how the unit startup sequencing will be happening at Dangote Refinery. So the first part is the primary unit. So we have been seeing that CDU have been commissioned, and it was a pretty good because they didn't face any major hiccups. So from last 2-3 months, they have been running at 240 to 260 kbd. But the major hiccups or major issue they will be facing is when they start commissioning the secondary unit. So we believe post commissioning of their CDU and other allied unit, reformer is one of the secondary units they will be commissioning in first, and as we have been hearing that they will be starting of the reformer in July, but till now we don't have any credible information that they are starting up or not. So our analysis is that they will be starting up reformer in commissioning startup of the reformer in July this month, and post that they will move to commissioning of mild hydrocracker unit that takes around heavy gas oil and converts to LGO, along with sulfur recovery unit, and when we move to Q4 they will be starting with mega MS block, that is Penex, that is ISOM or RFCC unit. Yeah, thank you. Next slide, please. So, ultimately, the talking point is, when will they produce Euro 4 or Euro grade product? So our timeline, we have assumed that for them to produce gasoline, we see that gasoline production will be slipping to next year. By gasoline, I mean Euro grade gasoline to Q1 or later part of Q1 2025 only. So Q3, Q4, we will be seeing commissioning of reformer along with hydrocracker and hydrotreater. So that will enable them to produce gasoline blend that is reformed and mostly low sulfur diesel. I'm not, please don't confuse that with ULSD, because it will, for them, it will take time to purge their tanks, lineups, and other with the product from hydrotreater and hydrocracker to finally come at ULSD. So we believe ULSD will be around later part of December this year to first month of 2025. Yeah, next slide, please. Yeah, so they have been able to ramp up, and because of that, product export has been stable. So since the beginning of the year, we have seen that they have been selling mostly straight run product domestically and globally because of the absence of the secondary units. And most of the exported product is around as a fuel oil that corresponds to around 30% of their total volume, mostly going to US and to Singapore. And then naphtha getting processed in some petchem unit in South Korea that corresponds to 26%, and high sulfur gas oil that has been mostly moving around West Africa, catering Nigeria's own demand and Togo. And one of the interesting factor is that who would have thought that Dangote Refinery will be supplying jet kero to Japan. So Kepler tracking data says that they have exported a cargo and it will be landing up in July in Japan, as the latter has been facing some localized jet kero issues. Next slide, please. Yeah, so here we talk about how the product ramp up will be in accordance with how the crude ramps up. So Victoria mentioned how the base case of the crude ramp up will be. So if we see, we are expected to see around 270 to 300 KBD of crude runs in the Q4 of this year. So looking at the product side of things, and with the reformer getting commissioned this month, that is July. So we see reformer will be running at around 50 to 60 KBD only because CDU runs are very low, and it will be around turned down capacity of the reformer. So, and around 85% of that will be reformer. Please take a note that the reformer produced will not be a gasoline, and because it's very high in RON, around 100 RON, 110, very high in aromatics, benzene. So we believe that they can optimize this reformate by either selling it as a high aromatics blend stock, or they can blend with the available naphtha that they have been exporting to produce a low grade of gasoline and use for their own domestic use. Moving into the middle distillate. So jet kero, they have been able to produce on spec jet kero thanks to the Merox unit getting commissioned along with the CDU, and they have, as we saw in the last slide, they have been able to maintain a steady jet kero export. Coming to the gas oil. So gas oil production straight run, they have been able to maintain at good rate. But what we see is that though hydrocracker and hydrotreater, mild hydrocracker and hydrotreater is expected to get commissioned in Q3, Q4, we don't see recent or early supply of ULSD only because the tanks, the lineups, and the pipeline that contains heavy gas oil or high sulfur gas oil needs to be purged to produce ULSD. So we see ULSD production in the later Q4 of this year only. So at full capacity, when that is expected to in H2 2026 only, Dangote will be able to produce around 300 KBD of gasoline, covering around 90 to 85 to 90% of their demand, and around 240 KBD of diesel, mostly for the exports, and around 85 KBD of jet, along with other gases. One of the important factor is if I emphasize is to that recent operational data for the refinery has been very promising. They have been able to maintain their runs at the turndown ratio. But what we saw in June 26th is a reminder that potential risks and challenges around the starting of the refinery of this size, in particular, a single train 650 kVd. We anticipate a significant challenges to ramp up for their steady operations. Yeah. Next slide, please. Yeah, this is also an important slide. So here we are talking about what we see as a product balances as the ramp up continues. So I will be starting with the top of the barrel and the bottom of the barrel. So again, naphtha. So naphtha export have been steady, mostly going to the South Korea. So, but it depends on how the reformer starts up. So as of now, our assumption is the reformer getting commissioned in July. So we see continued export till July, and once the reformer is stabilized, the naphtha export will be going down. And mostly, what as of now, what we see is that naphtha that is getting exported is a full range naphtha, comprising from light, middle, and heavy naphtha. But after August, we see mostly light naphtha getting exported because medium to heavy cut of naphtha will be getting treated in reformer. So again, naphtha export volumes is long for them, but it depends on how they start the reformer. And similarly, the story is same for the fuel oil. So for them to upgrade the bottom, the giant RFCC unit, and we assume RFCC unit getting commissioned only in Q1 2025. So till then, fuel oil export is expected to be heavy, low sulfur fuel oil export, directly competing with Azur's export. And gasoline. So all the points of Dangote is that, yeah, it will be able to meet Nigeria's demand, but it has to ramp up at the full capacity. So, and that is not happening anytime soon. So we see gasoline import healthy for the recent month until the giant RFCC comes up. But after that, after that, gasoline balances will be short for them, and import dependency will reduce as on when they ramps up and RFCC is getting commissioned. And for the middle distillate, story is simple. They will be and they have been exporting jet kero mostly to UK, France, and even to Japan. And for middle distillate, they will be covering mostly as of now Nigeria and other West African markets. And post they are able to produce ULSD. It will be interesting to see like how the freight dynamics and the high sulfur low sulfur spread takes them, and where they are able to target their market. Thank you.
Thanks, Sumit. Another great presentation. I mean, look, so much takeaway. Some of his takeaways there, the big ones for me, obviously, like I said, the slide deck will be available. The recording will be available as well, because there's a lot of detail there, and the devil is in the details, we all know. But we don't see ULSD exports, Euro 5 grade exports until Q4 24, the latter end of that, and Euro 5 grade gasoline exports until Q1 25. So another 6 months. And then what's going to happen about reformate optimization, as you mentioned? What do they do with that? How does the refinery deal with that? I mean, look, it's all conjecture, it's all ambiguity, and I know that you guys want answers to that. But we've got to assume, based on the reform, where is the RFCC? When's that going to go? How is the reformer working right now? We'll come back to that because we've got a few questions on that, and I know the timelines are really, really important, and I know that's what people want. So, fire in any more questions. We've got a few to go through. We'll do that after we've got Matt's session, and I'll hand over to Mr. Wright right now.
Brilliant. Thank you very much. So yes, let's turn to the freight impact. So my name is Matt Wright. I'm the lead freight analyst here at Kepler, covering all things tankers. So starting with dirty tankers. Once the refinery is close to capacity next year, we expect a decline of around 30 billion crude ton miles. And you can see the net impact here on the chart on the right. This will primarily come as a result of lower Suezmax flows to Europe, but also some VLCC exports to Asia. So you can see this is mainly just Nigerian flows from the first bar in that chart. But there's also potential for some additional losses in the system elsewhere from West Africa. As Victoria mentioned, there is potential for other West African grades to go into the Dangote refinery. If this happens, they would not be available for export elsewhere. Most of these, particularly Angola, is to Asia, into China. So this would reduce export availability, hitting VLCC demand. And that's that second bar, the reshuffle losses that you see there. There are going to be some gains, and this is the Nigeria imports, because Nigeria is going to continue to import and will increase imports of foreign crudes. So this is WTI and some of those other West African grades. But you can see, with the exception of WTI, it's a very, very small increase of other grades from elsewhere in West Africa. So only a small increase in the mix there. Then in the fourth bar here, we've got the other reshuffle gains in the system. And this is because for all of those countries that were previously, are going to suffer a decline in imports of Nigerian crude, they're going to have to look for upgrades elsewhere. So this is mainly European refiners, some of the ones that Victoria mentioned as well, such as Indonesia, South Africa. So what we're going to see is some of these refiners having to turn to alternative grades that would is going to increase ton miles on those voyages. So for Europe, for example, this is going to be an increase in imports from within the region, but also probably from the US. So there's a range of different, so this is supporting VLs, Suez and Aframaxes, because there's a whole range of different countries and crudes that is going to be brought together to support this. You'll notice the Aframaxes here are included because particularly for those short-haul voyages around the Med and around Northwest Europe, we're going to likely see some Aframaxes also from the US into Europe. Now, as they suffer none of the losses in terms of declining flows from West Africa, they only benefit from the upside. So as a result, if we shift to sort of the net effect, Aframaxes could come out on top here as a bit of a winner. For VLCCs, it's a bit of a wash. I think the net effect is unclear, maybe slight decline, but due to the fact that there's so much interchange in the vessels used, particularly from the US at the moment, it's difficult to say if that would be positive or negative, but I think it's going to be fairly small. For Suezmaxes, it's pretty clear we're going to see a bit of a decline. And that loss in terms of Nigerian flows to Europe is just not recovered anywhere else in the system. So the main story here is, a small decline in overall demand. However, Suezmaxes maybe declined by around 2%. So turning to the clean side, what's the narrative here? So on the clean side, we actually run two cases because it's unclear exactly what, and this will really be determined by where Dangote's ULSD is shipped. So for all of these, we're looking at 2025 versus 2023 ton miles. I'll start with sort of the loss in the system, and for both charts, it's the same, which is Nigeria is going to be importing less gasoline. They're still going to be a net importer, but it's going to be a big reduction. So we're going to lose both MR and LR demand on those flows into Nigeria. What happens next, however, is where we start to see a difference in the narrative for clean tanker demand. So if we see West African Nigerian ULSD stay in West Africa, we will see a more significant decline in clean tanker demand. Now, why would it do that? Sulfur specs in West Africa are lower than the expected quality from Dangote, but despite this, it may be cheaper for West African importers to buy Dangote ULSD, and Dangote may get a better price than shipping it to Europe because of the narrow sulfur spread and the comparatively higher freight. But this will depend on a few things, and one of them being the West African products market is fairly diverse. It's smaller cargoes spread into a number of importing countries. Does, as somebody on the webinar this morning raised as a question, does Dangote want to get into this? Or is it more straightforward for them to load some LRs and MRs and ship it to Northwest Europe, knowing they're going to get the market price for ULSD? The other case, shifting to case 2, is that exactly, where Northwest Europe is the market for the bulk of Nigerian ULSD. It's already going to be, we're already assuming it will be taking, or Northwest Europe, the Med, to be taking the bulk of the jet. So where will that diesel go is really a crucial question. I think the other thing to consider here is discounted Russian diesel. So under the situation in which, case one, where it makes financial sense for Dangote to ship that ULSD short haul, discounted Russian diesel could sort of offset that narrative, because it could sort of undercut it, pushing the narrative, Dangote more towards the Northwest Europe, the European market for its diesel. And then regarding the impact on rates, what do we think is going to happen? So whether we have, I think whether we have a net decline in ton miles or a net increase in ton miles, I think the impact on rates is going to be relatively muted. For one reason is that for any cargoes that are exported from Nigeria, it's key to remember that Nigeria will still be importing gasoline. And so while arrivals will be lower, there will be ships discharging, and these will be prime candidates for any backhaul cargoes to Europe. So this would reduce the overall uplift in rates from any higher ton miles in that situation. If we were to see a decline in ton miles as a result of more diesel staying in the region, we could see this sort of work as a bit of a downward pressure on rates. But we'll have to wait to see what happens there. And again, as Sumit said, diesel, ULSD is end of this year, early next year at the earliest. So with that, I will pass back to Matt for the Q&A. So please send your questions in.
Thanks, Matty. Yeah, look, thanks again, guys. Victoria, Sumit, Matt. I'm doing nothing here. I'm a magpie. I'm stealing their work and not even doing a good job of that. But anyway, like I said, the slide deck will be available. The recording will be available. We've got a few questions to go through. And look, we're going to keep the conversation not just, okay, very binary, we're going to answer one question after the other. It will be a discussion. We'll be having a discussion as we would if we were in a Shepherd's Market in IP Week, put it that way. Vic, let's start with you on the crude side. A couple of things here. But first of all, there's a lot of noise, not noise, sorry, that's the wrong adjective. There's a lot more focus outside of Europe in the refining sector in general, where money has flowed into in terms of investment. And Dangote has had this, especially within West Africa itself, Francophone West Africa, but the African continent in general. Obviously, now we're seeing noise about NNPC looking at starting up the domestic refineries in the coming years. So you have Port Harcourt, you've got the Warri Refinery, you've got Kaduna possibly coming back online, but Port Harcourt has really been the one that people have, I would say, are applying against each other at the same time. So Dangote is very much not lockstep, because no one really is quite sure yet where Port Harcourt are. But then we've got the new Centura refinery in Ghana and what's happening there. But sticking within the optics of what's happening in Nigeria, what do you think? What do you expect state-owned refineries? Do you expect them to ramp up over the next few months or the next year or so?
Yeah, let me take this one. Thank you. Yeah, there was a time when we had 3 state-owned refineries operating in Nigeria. But since 2016, they all started to shut down, and there was essentially 0 refining capacity left by 2018. I mean, we still have some modular refineries and illegal refineries running, but no state-owned plants. And so there has been a lot of news about plans to restart some of them. We believe that the only feasible startup will happen with Port Harcourt. So we have currently modeled a ramp up in Port Harcourt's refinery runs in our outlook for Nigerian crude intake. So Port Harcourt has 2 CDUs. The first one has a nameplate capacity of 60 KBD, and the second one has a nameplate capacity of 150 KBD. So we think that this year for Port Harcourt, there is not much going to happen. But looking to next year, we think over the first half of the year, test runs will start. And so we expect CDU1 to reach nameplate capacity of 60 KBD by the end of 2025. And so the main product output from this CDU will be fuel oil. But then when we look to 2026, potentially the second CDU will slowly ramp up. So Pura Core could run at levels of around 150 kbd in 2 years. And so then if we combine this with our outlook on Dangote's crude runs, that would actually then amount to Nigerian crude intake of 700 kbd in 2026.
Wow. Yeah, which I mean, look, I think this is why so many people are interested in it, regardless of where you sit in the supply chain in the oil space. You know, okay, this story that there's going to be this new refinery and then others are going to follow. People are a little dismissive and a little complacent, and now it's happening. And it's quickly, I think you're right. I totally agree with you that it's going to be a long, hard slog. And, you know, just moving on to you quickly based on what Victoria was saying with, you know, can we just, Matt, can we just go to slide, I think it's slide 11 that Sumit put together? Because I think that, you know, some tangible sort of, you know, Victoria's ones on the crude and what's happening there with balances, but the comparison, Sumit, that you've made to Reliance versus Dangote, I mean, yes, different refineries, different setups. Jamnagar, the biggest refinery in the world in terms of 1.4 million barrels a day with all units, whatever it is, and Dangote being a single train unit, the biggest in the world. We can ask questions about why they decided that setup at a later stage. It's probably a whole different webinar on that. But you know, the key thing here is the part where you say July 99 to December 2001, unit shakedown, crude runs begin, and then December 2001, Reliance have never looked back, right? That is when they started. Okay, it took them a lot longer, but these things always do. You mentioned about Al Zour earlier on. Would it be Dangote could go the same way in terms of, you know, the Reliance, say 2 years from test runs to final Euro 5 grade products? Could we say Reliance is a fair comparison to what Dangote will look like there?
So yeah, interesting question. So as of now, see, for me, comparing Reliance and Jamnagar was that Jamnagar has a two different unit, a DTA and an export unit, and with mostly with the single string refineries, and with Dangote being 650 kbd because of the size of the units. So as of now, we have assumed that for Dangote to ramp up fully, it will be around 2 to 3 years. Like it will be exceeding what Reliance did in the 2 years.
And look, Ambani, his son got married at the weekend. I gather it was quite the most glamorous affair. Whether Dangote's son, he's going to get married, it will be, well, let's wait and see. It depends how the refinery does. But no, you're right. I think this is a good slide, this one, to look at in what's happening. I mean, look, we've had a question in, like, you know, do we expect Dangote as a company to go with an alliance with another trader, or do they go down the path that Reliance took? Look, I'll just answer that one because, you know, I think personally it'll be a mix. I think that there will be some strategic partnerships that Dangote will make, but I think that it would be foolish at this time after, what did you say, when they first got the contracts awarded, it was 2014, to partner with someone now and give up a large chunk of the profits. I can't see that happening after everything that's happened. But I do think on the supply side, as Victoria said earlier on, signed a 12-month supply contract, I do think that there will be some strategic partnerships because they can run a fairly varied crude slate. So look, I think that's one to watch. Sumi, just want to stick with you for a moment because you had a slide as well, Matt, just on slide 13. I think this is another one that people will kind of do what you used to in the old days, which is print it off and sellotape it to the bottom of one of your screens. So you had always a reference point. But here, this is the timeline. So start of the year, we had the first test runs, CDU. And then a year later, we've got the production of gasoline. Now, let's just break that down, right? Because I think that these are the real crucial points. Is the products that are yielded and what it means for the trading community up in, say, Northwest Europe, which has long been the supplier. the reformer you said was starting in July. We haven't seen any news of that yet. When do you see the RFCC coming online? Have we got any idea on when that might be in terms of timelines?
So like based on how the past refineries have been ramping up in the sequencing of the unit, and as per our sources, I see RFCC starting up only in Q1 2025.
Okay. Because I got people telling me, no, Matt, you're talking nonsense. It's going to be next week. We can be fairly confident that our forecast at the latter end of a lot of people's what they're expecting when they're going to produce finished grade gasoline. We're pretty confident in our, what our model is telling us there, right?
Yeah.
Okay. All right. Look, I mean, that's sorry, go on.
Yeah, just to add it, like till we see RFCC and ISOM block getting commissioned, we don't see production of Euro 5 gasoline. I repeat it again. We don't see production of Euro 5 gasoline till Q1 2025. We may be seeing inferior or a lower grade of gasoline production because of a reformer they have hired on high aromatics getting or getting blended with light naphtha, but Euro 5 grade gasoline not expected till RFCC get commissioned, RFCC and ISO.
Okay. Fair enough. Look, I mean, I'm putting you on the spot there. That's about the sixth time I've done that today. So I'll give you a break tomorrow. No, not at all. Matt, just moving on to you, just what it means for, the freight. And you mentioned that, Aframaxes are likely to benefit, VLCCs a bit meh. But I think the question a lot of people are asking is, what's happening? Obviously, Europe can no longer buy Russian products. Sourcing material from elsewhere, the Gulf Coast, what's happening with hurricanes. I apologize to anyone, by the way, who's got skin in the game, because flat prices off $1 since we started this webinar. Don't blame us. That wasn't our fault. It was something else. But, in terms of where people have got to source material from, I mean, could the irony be that Europe import products from Nigeria going forward?
Potentially. I think and I think the implication is, what does that mean for India, Middle East, who have been sort of filling, the middle distillates gap, which is a much longer voyage. So it potentially a bit. I think, as I said, the sulfur spread and Dangote's motivation to get involved in the West African market, which, as I mentioned, is a short clip market, it could be a bit of a disrupting factor. It would be the freight is far cheaper from West Africa than it is from India, particularly with the situation we have in the Red Sea as well. So really, that could be a factor. And I think the other thing is, we're talking 2025. If we look a bit further ahead, I think it's very realistic to assume further rationalization in Europe, 2026 and beyond, which would increase import requirement for middle distillates, but decrease the crude import requirement. So that middle distillate short is only going to get larger, really. So whether this is a case, we're not expecting this until next year anyway. By that point, could there be, refinery shutdowns? Or, are we going to essentially see, European demand is not growing, but its net short could?
I hope there's no European refiners on this call, Matt. Do you know that? Because it's a pretty grim picture we're painting for them. But no, it's something that absolutely needs to be addressed, isn't it? Because, like I've said this a couple of times today, and I've been banging the drum for a while, investment appetite in the fossil fuel space simply hasn't been there in Europe. It has been there. We've seen Duqm, we've seen Jazan, Al Zour, obviously Dangote now. Assume it's said about the Aleka refinery in Dos Bocas, Yulong refinery in China. The growing areas of the world are the ones who need to fill the void when it comes to supplying the world, these areas, with refined oil products. Look, thanks everyone. We started with Victoria. I just want to finish with Victoria. Someone asked a question earlier on, which we covered, and I think it was a very good question. So, Vic, I just wanted to finish with this one with you. Nigeria was importing product from Europe earlier with Dangote. However, that product import may reduce as crude imports increase for Nigeria. In the overall balance, demand of West African grades will reduce because European refineries will have to reduce runs due to Nigerian product availability. Therefore, are we saying will there even be an impact of Dangote increased crude intake, or will there be a mere redistribution of West African grades?
Yeah, thank you. Yeah, so for sure we do expect a reduction in Nigerian gasoline imports from Europe, and this will contribute to a broader dynamic of European refinery closures that we're going to see over the next years. So in our estimates, we're going to see around 100 KBD of European refinery capacity closed down this year. This is mainly because of the Italian Livorno refinery. And looking to next year, should be above 200 KBD of capacity shut down. However, we need to remember that overall global crude demand is expected to rise over the next 2 years. And this is mainly because of various refinery capacity additions. So I'm thinking here about China's Yulong plant, Mexico's Dos Bocas, Oman's Duqm refinery. And so in our forecast, we see global crude intake surge above 85 million barrels a day in mid-2025, which would be a new record. And so, yeah, so this is why we still see we still see that West Africa's crude balance will tighten, and the reduction of Nigerian crude exports will have an impact.
Okay, well, look, let's leave it there. It's nearly 8 o'clock. I want to thank everyone for attending. Victoria Grabenvogel for a brilliant presentation on crude. Sumit Ratolia on the products. Maddie Wright as ever on the freight. We will send out the recording. We will send out the slide deck. Reach out with any questions we haven't covered. And we look forward to seeing you on the next one. Ciao.
Thank you.
Thank you.
Thank you.